Now, JPMorgan named top pick at Barclays. The price target goes to 187. They're bullish on the bank's upcoming earnings report. That is our call of the day. What I don't understand is why nobody owns this stock and they own other financials. Joe, you own Goldman and Morgan Stanley. Jim owns Citi and Goldman. Weiss owns Bank of America and Goldman. Weiss, why no JPM? What's the story here?
You know, I just thought that Bank of America was a lot cheaper stock. I didn't know where the marginal buyer in JPMorgan was going to come from. Clearly, it's been a mistake, kept going. But you know what? Made some pretty good money in Bank of America. And I continue to think Moynihan is the most unsung of all the bank CEOs out there. They've got a great franchise. And look, I'm sticking with it. I'm not buying JPMorgan at this level. Jamie Dimon is the most out front in terms of the press. Brian stays under the radar a little more. But you're going to make money in the banks no matter what you own. I just think going forward, you make more money in Bank of America.
Kerry, I mean, your largest position is square into how sort of Jamie Dimon is thinking about the future of banking himself, right? In that letter that he wrote today that I referenced earlier about how bullish he is on the economy into 2023, he did talk about Fintech and the threat that Fintech has to the banks. Right. PayPal is your largest position.
Well, PayPal has been a stock we've owned for years, and we believe that the market for transactions financially is just moving toward different types of payment. Digital is what they excel at. They created Venmo they bought Venmo, but it became an enormous franchise, which we all use, or most people seem to use. Visa, American Express is a name that we added over the last few months. Schwab and Blackstone. We own names and financials that are not money center banks because we believe it's an interest rate play, which, I mean, that's one-dimensional for the big banks. And the underwriting business is shrinking for them. A lot of their traditional sources of income are declining and are going to continue to erode. And they're trying to play catch-up in places that, for example, PayPal has been in for years, and we think that's a problem, even though we admit that the banks were cheap and you can make money in them and probably will continue to make more money. We think you can make more in some of these other areas.
Joe, why Goldman and Morgan Stanley, but not JPMorgan?
Well, Carrie and Steve are both defining exactly the strategic approach to financials right now. It's about beta exposure. You're going to get more beta exposure when Treasury yields are rallying 55 basis points in 20 days in a Wells Fargo, in a Bank of America, in a Goldman Sachs or a Morgan Stanley. Now, if we're going to see a moderation in the velocity for the move in Treasury yields, then I'm going to go back to a low beta financial services play, and that would take me right to JPMorgan. So I said to our producers before, I had been in Bank of America, I had been in Wells Fargo. I'm out of those names. I'm holding serve on Goldman and Morgan Stanley. But if conditions for Treasury yields remain as they are, JPMorgan, that would be the next money center bank name that I add to the portfolio.
But you're telling me that JPMorgan, you need to look at it as an investor or our viewer so differently than you look at the other big banks that you mentioned, because that's what you're saying. That's what you're saying.
Yes, you do.
But
yes,
that's
sir.
not how the sector trades, though.
Always look.
That's not how the sector trades, though.
No.
Right? I mean, it doesn't. I'm looking at the returns here. I'm looking at the returns. I mean, all right. Year to date, JPMorgan may be up slightly less than Bank of America, 54 to 60% respectively. And over a year, the gains are not that far apart either. But you're suggesting that you need to look at this one different than you look at all the others.
So over the course of a year, the gains are not going to be different because the move in yields didn't begin until the end of 2020. At the beginning of that one-year time frame, I own JPMorgan. I talked with you about owning it. Why? You wanted that higher quality, lower beta exposure. In the environment we're now in 2021, I'm sorry, I respectfully disagree with you. I know how institutional money is managed. Institutional money is now capturing as much exposure to high beta, low quality, weak balance sheets, interest rate sensitivity as it could possibly gobble up.
Okay. I'm just looking at the numbers. That's all I'm going by. But I appreciate your answer.